All right, welcome back, traders. John Caruso here, pre-market video for June 30th. Quick peek in on the market, pre-market. We've got stocks lower, S&P trading right around 37.70 right now, saw it as low as 37.50. This is a very important support zone for the equities markets. When I take a look at the volatility index, I do have the VIX sitting right around 30 right now, but I am getting an immediate term overbought signal in the VIX. The S&P 500 still has a little bit more room on the downside to become immediate term oversold here today. We're going to keep an eye on that correlation going forward. The NASDAQ is actually giving me a readout of oversold here this morning. And it's interesting to see following the hawkish speech by Powell yesterday and, of course, Bullard, that we've got the yields coming back in. Bond yields are down this morning. You've got the 30-year back above 138. The 10-year right now is above 118, and we've got the 10-year yield sitting down along 3%. So what is that telling me? That's telling me that the bond market might be sniffing out the idea that the Fed is going to go too far on its interest rate hike cycle, and perhaps the risk of recession is rising right now. The bond market is very good at sniffing these economic indicators out ahead of time. And then, of course, the Fed catches up on a lag. So you look at the commodity basket right now. Commodities are getting hit. We've got gasoline down about 360, breaking a key trend line yesterday. Oil prices back at 109. We've got grain prices that are starting to extend their slide here this morning. Silver is lower. We did see gold get down into support down there along 1800 and has since bounced back to 1823. So yes, we're at the part of the cycle, we believe, where the risk off starts to hit the commodity space right now in terms of demand side fundamentals. Clearly, the longer term supply side fundamentals for commodities are still very bullish, but right now, I would not bet against the Fed in accomplishing their goals in terms of staving off inflation and perhaps the risk of pushing the U.S. economy into a recession. Let's take a step back here and take a look at the economic environment right now. Take a look at inflation. We've got 8% inflation. Economics 101 suggests that we need to push the Fed funds rate above 8% to stave off inflation. Now, with the Fed, right, what I think the Fed understands right now is that is not an option. They're not going to be able to take the Fed funds rate to 8% with the asset bubble that we've created over the last 10, 11 years. Okay, so I believe the Fed thinks that their only way out is through a recession. Their only way to get inflation under control is through a recession. Because raising the Fed funds to 8%, that's out of the question. Do you understand what our interest rate payments to our bondholders would look like if that were the case? Back in 2021, we paid out $500 billion to our bondholders at an average Fed funds rate of 1.5%. Could you imagine if we raised the Fed funds rate to 8%, what the interest rate payments and servicing the debt would look like at that point? Not a chance. So I believe that this is the Fed's only way out is to overshoot on interest rate hikes, cause a recession, and that's where we kind of stand with things right now. So best of luck to you out there. We'll try to catch you back here tomorrow. I'll be having an early day tomorrow, taking off for the holiday weekend. We'll catch you then. Take care.